What's going on, guys? It's Chris here again with Retail Agri Trader. The date is August 27th, and this is going to be a real-time trade overview for trades during the week of August 27th to the 31st. We will be using a simulated account to simply annotate the trades we are actively taking, as well as the process of building the trade and to demonstrate the risk-reward associated with the trades. All trades will be conducted with a single contract per strike to show the value of profit and loss per contract. Before we go over new trades, let's look at some of last week's trades. Alright, let's take a look at BABA, B-A-B-A after earnings. Earnings was on August 22nd, so yesterday. We're sitting right around the middle of our range. We sold a 190 and a 165, which established our iron condor range here. And so 190 here at the top, 165 here at the bottom. We're sort of hovering right around the middle, which is right where we want to be with an iron condor. We've currently collected, we're maintaining about 107 profit out of the 115 total credit that we could have received. So being that we're so high up there, and there's only a day left on these, we could let it run till expiration, but I mean we're only gonna get about another $7 worth of credit. So we're just gonna go ahead and close this trade out since we're so high at our, so high up, close to our max credit possible. All right, so we'll bring it over, and we'll go over here to these little three dots. You just click that, close trade, and you can go on market order, limit order. We're just going to go with the market order to get out and place order. Yes. And we got an order filled. All right, let's take a look at these three trades now that it's the weekend. Today is August 25th. In the top right here we have BABA, which we closed out a few days ago, the day after earnings. BABA did very well, with the top side being 190, bottom side being 165 for our iron condor. We had a nice implied volatility drop. Price stayed right in between that range, and it ended up expiring. The contracts ended up expiring worthless, so we could have got that extra, $7. But we ended up taking about $107 credit on that trade, just because we closed it out early. We were up so much, didn't really want to risk losing any of that credit that we had in case it spiked up or down for some reason. Bottom left here, target. That trade ended up expiring worthless. We did collect the full premium. We never ended up closing it out just because it was always so high to this top side range. So we were down a couple bucks at one time. I think we were down $10 or $20 at one time, just because it was peaking above that range. And it ended up coming back down and closing out worthless. So we did collect full premium on that. Nice implied volatility drop. And then Lowe's. Lowe's is the one that closed for a loss. It closed above 106, so we sold the 105, bought the 106. That was the top side of our iron condor. Ended up closing 106.80. We waited and waited, tried to see if it would come back down into that range to close out. We went into the trade knowing our risk, knowing our probability, but there was error for margin. You go in with 85 to 90% probability. There's always that 10 to 15% chance that you might lose. We ended up losing that one. So hey, man, you can't win them all. But overall, we did collect a positive credit, and we'll be looking to collect all the credit on our next couple trades, which we'll be going into right now. All right, let's take a look at this week's trades. The first trade we're going to be looking at is CRM, SalesForce. They report earnings August 29th after market closes, so in 2 days. Historically, over the last year, after earnings, they've dropped about 30% in their implied volatility. You can see right here the implied volatility is relatively high comparative to the last year. We're currently at a 98% IVP, meaning that over the last year, implied volatility has been 98% lower than it is right now. So we're definitely in a high premium environment. We're going to look to capitalize on that. The largest move over the last year has been $6, so we're going to try to stay outside of that. And the float is 697 million, so we're not expecting too volatile of a move. Based off all that information, we're going to go with an iron condor for 31 August, since earnings is the 29th. For our low side range, we're going to be wanting to stay at least over 70%, somewhere in between 70 and 80% of our probability. So we're going to look to go with the 145 and 143 for our bottom side. to form our iron condor. We'll sell the 145, buy the 143. For our top side, we're going to look to stay within around the same probability, and we're going to be going with the 160 to 162.5, which will put us up near the 80 to 86% probability. To set this up, we'll come to our options chain, and we'll go down to the 143 and 145. So we're going to sell the 145 put, and we're going to buy the 143 put, and that's about a difference of $34. So that's be the credit we take in on that trade using a market order, if we use a market order. On our top side range, we got 160 to 162.5. So we're going to sell the 160 and buy the 162.5. And that's about another $30. So we're looking at around $60 or so on credit, with a max risk of being the difference between the strikes. So we have 250 for our 160, 162.5 minus the $60 credit we take in. We're looking at about a $190 max loss. With the $60 credit we take in, that gives us about a 30% return on the money risked. So we're going to go ahead and look to set that up. We'll be doing a limit order here, and we'll look to take in about $60 just based off of what we've discussed. So we'll bring this down to 60. Limit order, everything is in. Place order. And yeah. And we got order filled. Let's go over and check this out. Positions we're currently in. Let's check our fill price here. Trade price, we got 126 and 92. Yep, so right around what we were wanting, about $30 per side. Great. So we took in $64 of credit right there. All right, next trade we're going to be looking at is EWZ. EWZ is not an earnings play, but it is a high volatility play. We're sitting at 42% implied volatility with a 33% historical. IVP is 98% with a float of 172 million. Over the last year, the max dollar move in a single day-to-day was $2.69, so we'll stay outside of that with our spreads. Based off of the float, I was looking at doing a reverse iron condor or a strangle, but with nothing to provide really a catalyst here. There's not really much reason to do something that is trying to bet on, going one way or the other. I'm not really expecting it volatile. It's a low float. It could it could move very volatile, but based off of it being, a Brazil ETF, nothing really. I looked into it. There's nothing really happening with that right now with EWZ. Nothing coming up, but it's high volatility. So again, we're just going to go with an iron condor. Keep it simple. The iron condor I'm looking at is 34.5 on the top side, which will keep our probability around 80 to 85%. Bottom side being around 31.5 to 31, with the bottom side being outside of our probability. But when we look at the options chain for EWZ, we'll see that even though it spiked, so when I was looking at this Sunday, it spiked up on Monday's open. So it's a little higher than what it was calling for over the weekend. If we look at the 31.5 and 31s, we can see the probability of out the money is around 80, 85 to 90% between the two of those. So that's what we're going to be going with. So when we set this up, we're going to be looking to go with the 30 to 31.5. So we'll sell the 31.5 and we will buy the 31, and we'll come down to our top side of 34 to 34.5, and we'll sell the 34 and buy the 34.5. And that gives us $5 or so there with a $50 risk. And this will give us about $6 here with a $50 risk. So based off of that, with about basically a 6 plus 5, we're looking around $10 of credit or so, with a $50 spread different or strike difference minus the credit we take in. We're looking at about a $40 max loss with a $10 credit, giving us a 4-to-1 risk and about a 25% return. So when we set this up, we'll set this up to take in about $10 of credit, because that's what we're looking at here based off the bid and ask using market orders. That's the current best price. We're not going to try to undercut anybody. We just want to get filled. So when we come in here, we'll do $10. Place order. Yes. And we got an order filled right off the bat. Go figure, right? Come in, manage tab, make sure everything went smooth. We got filled at 17 credit. So there's $6 credit there, and then $6 credit there, $12 credit total with a $50 strike difference, giving us about a $38 max loss. So that'll be a nice little trade if we end up winning that full credit. All right, let's take a look at Lulu, LULU. Lulu reports earnings August 30th after market closes. Historically, Lulu has had about a 50% implied volatility drop over the last 4 quarters of earnings. Lulu is somewhat of a low float at 108 million with a max 1 year plus or minus move of $17. So we're going to try to stay outside of that. I looked at strangle straddles and reverse iron condors. I didn't really see anything that I liked as far as, risk to reward. Nothing that was really worth my time as far as profitability. But I did find an iron condor that, might work out pretty well and gives us high probability. And it keeps us outside of that max move. And it keeps us outside of the market's expected move. So what I'm looking at is the 155 to 157.5 for the top side, which will keep us above 85, somewhere between 85 and 90% probability. And the bottom side of 122 to 120, which again will keep us around 185 to 90% probability. So let's take a look at the options chain provider. We'll see what's going on with that. We'll go ahead and cancel out this trade that didn't get filled. And let's look to set this up. So we're going to be selling the 155 and buying the 157.5. And we'll come down to the bottom side. And we're going to go with the 122. So we're going to sell the 122 and buy the 120 put. Again, this is for 31 August. We got about 20 between the bid and ask, so we're just trying to get filled. We're not trying to undercut people. Between the bid and ask, we've got an $87 here and a $71 there. And then down on the bottom side, we got a 103 and an 82. So if we just try to get filled with the top side being around 21, and down here at the bottom side, we've got 87, about 16. So we can try to get filled around, that's $37 credit. We'll try to get filled around about 35. So we'll use the limit order and we'll bring this down to about 35 and see if we can get filled. And right off the bat, we got order filled. Good. Let's check our manage tab just to make sure our fill prices are correct. Okay, so we got filled $104 credit with $84 debit and 89 to 72. So right around what we were, expecting. We got $17 on the bottom side, and with the top side, we got $20. So about a $37 credit total. The largest strike difference was 250, so we'll take 250 minus our 37 is $213 max risk. With the $37 that we took in, we subtract that from our max loss, and we're looking at about a $17 or 17% max return, which is pretty nice. All right, next trade we're going to be looking at to get into is, this will be the last one, is Netflix. Netflix is not an earnings play. However, Netflix has some nice volatility going on. It's 52% for the IVP, so 52% of the time it's been lower over the last year. However, looking at the options chain, I did find a trade that kind of stuck out and provided a pretty decent return. And I looked at all different kinds of spreads, and again, what stuck out was an iron condor. So this is before iron condors. The one I'm looking at is 340 and 342.5 on the downside. So that's going to give us right around 70 or 70 to 75% probability, with the top side being 37 or 377.5 and 380, which is going to give us closer to 80%. So and when I was looking at this Sunday, the close is right around 360. This is spiked up to 371. So that kind of puts odds in our favor, just being because it's already spiked up for the week. It's already tried to fill some of that top side max, market expected range. So we're going to try to get filled, and hopefully that, that will pull back down, and that'd be great because it's not more than likely not going to fill our bottom side. The top side is what we would have to worry about since it's already so close, but since it's already so much up for the week, and I don't really see anything scheduled for Netflix as far as catalyst, not expecting it to go too high. So the spread we're going to be looking at is 342.5, and we'll pull that up. Netflix. And again, this is going to be for 31 August. All right, so we're going to be going with the 342.5 and 340. And where are we at here? 342.5 and 340, which gives us about a $9, $8 to $9 credit. With the top side, we're going to be looking at 377.5 to 380. So and here's where it gets high. Look at that premium, $5.40. So we're going to be looking to sell the 377.5 and buy the 380. And that's giving us about a $65 credit, roughly $60 to $65. Based off of that, we got a $60 credit on the top side and just about a $7 or so credit on the bottom side. So that's around $67 credit total. We're going to try to get filled at, see if we get filled at 65. I'll accept that. That's pretty good. And we got order filled. Let's check our fills. We got filled at 40 and 33 and 540. So great. We got $60 credit there. As well as about $7 credit on the top side, so 67. With our $250 strike difference, we minus the $67 that we took in, we're at 183. And then if we take that against the credit we had, looking at about a 36% return. It'll be the max return we can get on the money risked. All right, so those are the 4 trades we're looking at for this week. I hope this was educational. If you have any questions, feel free to ask in the comments. Also, if you're interested in any of these indicators that we're using right here, check out retailalgotrader.com. The one that has our probability and range, that is the range finder. You can find that at retailalgotrader.com under the indicators section. Thank you. Have a good day. We'll see you next week when we exit these trades and enter some new ones.